Well, guys, it's been a while since we've seen something like this. 5 days of consecutive selling, a 100-year-old market cycle theory, and tensions in the Middle East completely boil over. With big tech earnings starting to kick off with Netflix, it's clear that forward guidance will be important, and this market will care about earnings. While we closed on the low, which suggested more selling might be coming, we probably didn't expect what's happening in the futures right now. But don't worry, we've got the biggest levels coming up in today's show, along with the weekly 20 moving average and whether it can end up finding bull pressure to hold it, the negative gamma situation in the trillions of dollars of options expirations, CTAs continue to dump, and whether we could enter into a proper correction or crash in these markets. Transportations, home builders, and Tesla's fall from grace from retail traders are coming up, along with central banks absolutely dropping it when it comes to liquidity. Wow, we've got a lot to discuss. Let's get into stocks, commodities, and cryptos right now. Well, welcome back, everybody, to The Daily Show. My name's Tom, and as always, we're covering the macro, the data, the lead indicators, and the hottest charts, and why they matter to all of us as traders and investors. If you want to better educate yourself about how markets move and how they link together, then remember to subscribe and smash that like button. So it looks like a drop bear just hit the markets. We went from greed a month ago all the way into fear, and at the time of this recording, things are actually getting a little bit worse out there. But what's really going on? Well, this marks the 80th instance since the 1990s where we've had 5 consecutive down days in a row. We ended up being 3.6%, though it looks like it's going to be a little bit worse than that. And if we do end up selling for a 6th day, that will be the first time since 2022, which actually marked the low point and capitulation of those particular sell-offs. So what tends to happen next? Well, one thing is that it usually is a bit of a slower recovery. Overall, it takes 44 days on average from when we sell off 5 days in a row to make it back to the top. And this supports the idea that we're in a bit of a chop or pullback in time or corrective move in markets. So with selling coming in, should we be concerned right now? Well, there are some signs that say that the core indices are starting to look a little bit weaker. Of S&P 500 and 600 stocks, we have a huge difference. 53.1% of S&P 500 and of 600, only 30.7% are actually up year to date. And it again shows you the signs of the mid caps and the small caps not quite coming through on this market just yet. Russell 2000 would be expected at 31.3, but probably where it most surprises you is the NASDAQ. 35.6% of stocks only up throughout the year. So let's continue with the breadth story and take a look at this chart here, which is, of course, all of the stocks throughout the major caps and where they've been sitting. Now, you'll notice that 25.6% of small caps were at their lows. That's probably going to go and elevate itself over the next 24 hours. And that we've been seeing a weakness through the mids and the smalls more. Why? Because it's higher for longer. But if the mega caps, if the Mag 7 stocks do not hold up in earnings, and more importantly, forward projections, get ready for some capitulation. We could be seeing ourselves at 4,700 incredibly quickly. In terms of the S&P 500 sectors above the 50-day moving averages, that's starting to get down to usually where we see kind of like dip or corrective points. And you'll notice here in previous sell-offs, when we tend to come down kind of aggressively, we usually hit into somewhere between the 25 and 15 zone. Now, are we there yet? As of the last recording, we are literally sitting at 27.27. If that changes towards further downside action, it will be important. On the flip side of this, though, the percentage of S&P 500 sectors with the 50-day average above the 200-day average is still very high. So it shows you that for now, anyway, the market is still in a very bullish move, and this is just to be considered corrective at this stage. Let's move over to why there are some stats that are going with maybe even a little bit more weakness before strength. When we have these consecutive days where we open up in the mornings and then close by the end of the day, it's kind of rare. We haven't seen too many times, but we did have it this week. And the 1 month return is choppy at best. The 2 month return is also choppy at best, but the 3, 6, and 12 months remain very bullish. So it's kind of like looking at this as the correction we almost had to have. Remember, the storylines right now are higher for longer rates. Well, we've had them for quite a while in the market, so probably just an excuse. The storyline is also geopolitical tensions. Again, we've had many geopolitical tensions for quite some time. And then the next storyline is obviously now growth concerns. Well, we'll see how that one plays out. That's probably the real one in markets right now. If the Mag 7 stocks don't hold, yeah, they're going to freak out. Let's have a look here at core leadership models. You'll notice that stocks are dropping across the board. That's pretty normal during corrective moves. We'll alert you whether we get into a really weak leadership level. As they say, the blood in the streets, and that's what we'll be watching and looking for. So we've been talking a lot about the idea that commodities and more importantly, metals and minerals are starting to look really good. Well, did you know that commodities allocations that we shared over on our X account, following the links in the description down below, have just done something really wild, a huge increase from some of the biggest players in the street. The last time we saw this was coming out of the big sell-off in March of 2016, June of 2020, and right now in April. So I went back and had a track of some of those particular times where we saw inflows, and what happened next was pretty good. Actually, we got pullbacks often throughout the next kind of month or even couple of weeks, but overall the next year was very nice for the commodities markets. And I think we're in a similar situation right now, which we've been discussing. And we've got many, many stats leading back over the last couple of weeks that could suggest that commodities, minerals, and metals might be actually just starting to heat up in terms of a massive rotation from the street itself. Will AI still play a big part? Absolutely. And we'll talk about semiconductors just coming up. But let's jump into the S&P 500 because things are getting wild in this particular market. You'll notice that we've come down and it looks like we're going to fill the gap that's been sitting there for so long. The 49.80 zone, also known as the weekly 20 moving average, is a very important level for the markets to hold this week. And with sell-offs that are starting to now accelerate past that point in futures, it'll be very interesting to see whether we get a strong buy throughout the Friday or continue to see weakness. Where's the next bull zone? Well, it really sits all the way back down here on the weekly at 4,700. And you'll also notice that's where the weekly 50 moving average is, which is a very key zone. In most bullish markets that remain bullish, the biggest pullbacks that you tend to get are towards the 50 and the 20. And you'll notice that in the point here of 2019, we came back and we hit the 50 quite a few times. We hit the 50 many, many times throughout the 16 into 17 run. And that tends to be the best dollar cost average zone for most technical traders. The 20 moving average, though, can also be the only one we hit, which is where we're at right now. As you can see, the 2020 run was very, very aggressive. And every time that was just hitting the 20 moving average. To demonstrate, I'll change this right now so you guys can see it together, how important this particular weekly moving average or mean reversion is. Notice the hits, very, very key level. So because we find ourselves here, then we need to think about whether this is actually a good corrective pullback. In general, markets move between 5% down in a normal kind of sell-off all the way to kind of 10% down. And what you'll notice is that both of these levels mark out very important zones. This one is the 5% down. This one is the 10% down. So really, it's kind of statistically likely we would stay inside of those areas if we were in an overall very bullish market with decent breadth starting to increase. Now, here's where things get interesting, and I actually re-recorded part of this just because I wanted to show you the market falling through that 49.85 zone. So this still is the major bull level. Of course, we're in futures market trade at the time of this recording, and you'll notice it just took out some of these lows, in particular 49.50 and 49.27. It's trying to find a little bit of buying through here. So unfortunately, a lot of people will have lost stop losses here in the futures. They might have even been hunted. But the way the market reacts here will tell us a lot about next week. If it closes low and it closes on its low, that would suggest that any pullbacks will be met by sell demand, and it kind of points towards that 4,700 level. For now, though, we'll just look at it from, we know where the options sit, and we know that there are a lot at 5,000 and 49.80. And being in a negative gamma situation, if the markets do end up closing low, they're going to need to be hedged. What do? They sell futures. That tends to lead into more cataclysmic kind of waterfall scenarios. So the market for now ended up coming up to our supply zone we marked out over the last 24 hours. That was a very good short if you did manage to get into it from a day trade. And if you held, you'd be pretty happy with where it's at right at this particular point. When we go back up to the higher time frames, such as the daily, you'll notice here again, we've just got those kind of levels marked out. And I also have an anchored VWAP sitting behind, which sits at around 48.50. So it is possible that the market would either bounce around here, or it would even do this and then come up really quickly. If there is a massive wick on the closer, that will be important. So subscribe for our weekend edition because I think this will be a very telling story. When we go over to the 0DTEs, when we said negative gamma, we really did mean it. I mean, there are so many puts sitting at 5K. There are a lot of puts sitting at 49.75 for the Monday trade as well. So what this is suggesting is not only does the OPEX have a lot of options moving on it, but also each and every day, we tend to just be sitting here stacked with puts that keep pushing the markets lower as they close below those points. So if we do manage to close below, these will need to be hedged, and we'll update you with the ones moving forward for the Monday, the Tuesday, and a few other sessions next week so we can see what happens. But yeah, 5,000 will be an important level to hold. Will the CTAs continue to sell? Well, so far, yes. So commodity trade advisors, often considered early in markets, we reported on them slowing down recently, hitting into their kind of peaking periods, and it's a repeat of last year. What happened when we saw August, September, October sell-offs tends to be happening at this point once again. And while it might not be as brutal as that sell-off was, we certainly are seeing it come back into the norm. This is the move that had to happen. We were so heavily long from the CTA side. To see them dump on both the S&P and the NASDAQ is a perfectly normal scenario. What we'll be looking for now is if they start to increase and price action starts to turn around, that would be a good early warning sign or early sign that the market's actually starting to recover. So let's see if it's still a stock market correction. Well, it's not 7 of 7 reads anymore from Grant Hawkridge. What it is 5 of 7. And I tend to agree. I mean, you're always going to get this one not showing whenever you sell off. So that's the percentage of S&P 500 stocks above their 50-day average. That's generally always going to show a no in terms of being, a bigger sell-off, which you hope for. And of course, his particular core leadership model is also dropping, which is, again, totally to be expected. I think the biggest thing here will be price and making sure that I believe we hold above more the 4,700 zone than the 4,796. And this will be my key level that, of course, we're watching on the charts moving forward. Let's also move through to whether this is normal in an election year. While election years are generally positive years for markets, they're not susceptible to decent drop-offs. In fact, the average over time has been quite negative. In fact, 13.07% is the average of a lot of these election year sell-offs. And we're looking at a very similar kind of potential here of maybe even upwards of negative 10%. So if we took out this one, of course, and the outlier here of 2008, I think you'd get a more likely kind of round about 9 or 10, which again would put you into the weekly 50 moving average. So is this normal? Yeah, it's pretty normal. Where are the opportunities? Well, one thing that's getting sold off more than others is actually healthcare. Now, we'll look at the market sector a little bit later on, but when we get a McClellan oscillator this low for that particular sector, the one-year results are 100% positive, and we've got quite a lot of reads. So a statistic that's pretty rare, pretty good, and it does show you that healthcare is actually getting battered a little bit more than it should. I'll show you the zone, though, that I think it might go to before it starts to see recovery later on. Let's now overlay some markets with correlations. Should we be seeing a pullback here? The answer is yes. In pretty much every correlated market that has a 0.93 correlation, you'll notice that there are pullbacks or turbulence around this point. And also in any kind of bull market that we usually get, we generally do again see weakness once we come out of the gates this strong. In 2012 and 1976, which are still the most correlated markets to now in terms of where we're at if we take a longer stretch, this tends to be that pullback period. We can go sideways to even more corrective like we did in 2012, but we do end up over the next 6 months generally positive. So I think it's important to become a little bit optimistic here during what is going to become probably quite a pessimistic time. Remember, you generally never want to buy when markets really start to sell off. And I think that the excuses so far are not the excuses the market's really using. I think it is most likely going to be on earnings. And there are some concerns after Netflix of what's going to happen with the rest of these mag stocks. When we take a look here at the secular bull run, we're still theoretically in the bull run, and we're also theoretically in a point in time where we generally see some weakness. So again, totally in line with what we expected. Now, some people messaged me saying Netflix was a crazy after the market. I don't think it was. The options market actually thought it was going to be plus minus 9. It ended up being, -5 or something like that. And there was like a drop followed by a bounce followed by a drop. Just remember, look at this type of thing. Earning Watcher puts it out. I believe there's probably some others that do it. But the options market will give you a bit of an expectation on how wild it's really going to be. Netflix is just the beginning. Next week, wow, we've got some massive earnings. So I expect some huge volatility and probably literally trillions of dollars to be moved around in the markets, not just billions this time around. Bitcoin ETFs are also starting to look a little bit negative. Now, some people would say, oh, it's time to buy Bitcoin ETFs, but they've gone from a super positive inflow to actually a negative outflow. Of course, we're doing battle with the 60K zone. If we do end up losing that zone, I've talked many times about 52K being the potential for the next area. And I thought it was an interesting chart. This is actually an old chart, but I thought it might be interesting to see the biggest holders of Bitcoin in the world in terms of ownership by country. This is taken from a while ago. It's actually Turkey, then Vietnam, and you'll notice the US is actually down here. So yeah, interesting stats in terms of who's holding the most amount per person in a country in terms of Bitcoin. Retail interest in Tesla. Tesla is not performing well. I did a quick check on what you guys thought over on X. And I said whether you thought the 145 gap fill was the next level, 123 big support zone, or it's going under 100. Everyone was really mixed. But one thing that isn't mixed is that retail participation in what was considered the retail stronghold, being Tesla, is down into the 28s. This is the worst I've ever seen it. You know, it was up at one point at 39, even higher at one point. This was the retail traded stock. And yeah, clearly you guys do not like it anymore. So it's getting capitulated at the moment. We'll see where it stops. Look for market structure. Buying the dip here could be incredibly dangerous if you don't find the right levels. Let's go over which zones were moving up and which were going down. As expected, semis and tech continued to sell off. Semiconductors going down is a really good thing for markets. You might say that's terrible. I think it's the correction that we need to have. And we reported this actually well over 2+ months ago when we saw that NVIDIA, whenever that big NVIDIA sell came through, that this was more than likely to happen. Now, no one really believed at that point. Of course, now you're all thinking, oh my goodness, semiconductors, they're totally overpriced. I think the semiconductors have a very bright future, as I'm sure most people do out there. And it's really just about getting it back to the mean reversion, which we'll go through. Over the last 5 days, all the things you'd expect are holding up. The defensives and even the metals and gold still holding better than others. But so as you guys know on the channel here, we track what's moving forward in terms of central bank liquidity. And over the last 24 hours, we saw a massive drop in central bank liquidity, which also happened to spike on over to the world. It came from the Federal Reserve, basically, and it all has to do with the TGA. But it wasn't just the TGA that was dropping, although that made up $257.4 billion overall. Now, is this normal? The answer is kind of yes. It does tend to happen around the April periods of the year to do with taxation. But what you'll notice is what happens after this will be important. Do we continue to see the overall support for the market drop off in terms of liquidity like we did back here in 22? Or will we see a quick spike up after it drops like we did over here in the April period of 23, where we saw a spike straight after that? This will be an important week, and not only do we have earnings, but of course, we've got now central bank liquidity starting to drop through. And the TGA is often considered pretty important in terms of influencing short-term interest rates and, of course, liquidity conditions in the financial markets. So it's one that we will be watching. Let's move over to the VIX. So the VIX is going to come out of the gates very strong when it resumes opening. You would think that if this market continues to hold down here, we're probably opening at a 20 plus, and the VIX will be certainly something that we're looking at very closely. That will put us in kind of bears are in control of the market even more. We see here as well that options in the bonds are blowing up. This is again one of our early indicators. We saw it over here. It turned out it was true. It continues to look towards the sell side. And of course, we're looking for this to start to drop back down to the other end to really show us that the bottom is in. And we don't have that right now. At the moment, it's accelerating on the upside, showing us that risk is still around in these markets. It's basically a risk off. Now, you might think this means yields are going up, that everything's selling, but actually it's concern across the board for growth. I'm pretty sure that's what, the market will be coming up with all sorts of excuses for it. But notice here that all yields will be dropping. Treasuries probably will be up fairly big, coming off that 61.8 zone that we've been discussing. And while I don't think treasuries are a trade, this is certainly the zone that you would be kind of interested at. A 61.8 golden pocket fib pullback of what was a very aggressive run. If the markets do start to slow, remember, all of a sudden we're going to go from, we've got these high yields to, wait, we need more cuts. So I expect the yield curve to get kind of wild over the next coming weeks. Let's move over here to, of course, the commodity trading index. You'll notice it has a nice base. Pulling back, that's pretty normal. We want it to pull back here. But as I mentioned in the previous kind of analysis, when we tended to see these types of reads, which were over here, we actually started fairly decent overall runs. Now, that's a longer term perspective. We don't always do those on the channel. It's something I've been looking at, and of course, we've been focusing on a fair bit in recent months. Dow Jones Transportation Average, the Dow theory is negative for these markets. To see the Dow Jones where it is, to see transportations accelerating their sell, volume to get really, really high, this is all pointing towards at least getting down into these zones here, which are around 14,750. I don't know whether it's going to keep accelerating, but you notice that this and home builders are both starting to weaken. So it kind of, again, just goes along the lines of everything's weakening for now. We look for structure. We look for the market to actually show us that it wants to buy. And then you actually, hopefully can trigger the right positions. Dollar index is starting to rise on the selling of the markets. Even though yields are down, dollar is just going up. The USD is, of course, the major. So in times of fear, sometimes people move into the US dollar, but it's not going up on yields right now. It's going up on fear throughout the world. And yeah, it's basically trading at the res. I don't think it's an easy trade there for the dollar just yet. What about copper? Big breakthrough. Look at this, 4.45 for copper, hitting into another minor take profit here at 4.45. I could see it even going up to 4.75. Still very bullish on copper over the medium long term, and still technically bullish on gold. I had a look at the charts here on the small time frames. Look, it just keeps kind of plowing through. It actually took the high just then at 23.98, signaling that pullbacks are still to be met by bull demand. It barely held on to this trend line over the last couple of sessions, and it's melting up. And basically, it's a dull market. You don't usually short those. I don't usually activate anything big term here, but I would certainly be looking at the scalps and the day trades. And right now, it's trying to go towards a new high on gold. US oil, big bounce. So that's huge, actually. That bounce is quite large. Concerns over, of course, the Middle East, I'm sure. And we came down. We didn't quite hit my level. I actually thought we'd get to 81.30 before seeing the bounce. But that's a pretty big bounce in oil. It signals a change in trend, which really occurred actually in here. And if I was recording a little bit earlier, I would have said, yeah, pullback here would have been pretty nice towards the long. Anyone that got that, well done. We are trading at the first TP for now. But yeah, oil just spiking up over concerns. It's back at a res, so this supply will be pretty key. But that's a pretty big move for oil. So certainly coming out. I think it's at res now, so it's going to be a little bit tough to trade over the next 24 hours. Tesla, the thing that keeps falling off. So we've got the obvious ones. The obvious gap fill could be the next level. I was not happy if you were looking for a day trade towards how it traded over the last 24 hours. Of course, I'm Australian, so sometimes I have to sleep during these times, but that day would have been a day I usually would sit through if I wanted to trade Tesla and see whether it could regain that level. It failed to do it though, so I'm glad I didn't stay up for it. And it just basically closed on the low or close to the low, creating a long leg doji. And it kind of signals further sell-offs could be in store. 145 is the obvious. I've got 123 as well as a key level with that kind of structural zone down here. And nothing really seems to be improving for Tesla just yet. So watch the price action. We liked the idea of getting a swing trade through here a little while ago, but just couldn't do it. And then once it did that close, and it was bad. So go watch our weekend video because yeah, it was really bad on Tesla. Let's move over to Netflix. This one here, post-market action, is underneath the coil. So it opens up at about 584-ish. I don't think it's an easy trade, even after earnings. If you wanted to, you'd look for a rally into a short and maybe into a gap fill. Basically, it just is a sentiment read. So the sentiment is that Netflix's growth might be slowing. Why are they hiding the figures is the question everyone will be asking. And it doesn't really lead into being able to elevate or keep these prices for now. Semiconductors falling, of course, 208, probably moving down to 200. I would like to see semiconductors fall down to this level. That would give us a mean reversion. That would give you a pretty decent pullback from the top. And it's in line with everything we've been discussing. Nvidia, though, still holding up strong. This is a good stock. You can always tell a good stock because every time the rest of the market's selling the weaker semiconductors, this one sells, sure, but then it's bought straight back up. There's no question in my mind that eventually Nvidia will be at newer highs. I would love to see it back down into the 780, 800 just because I think that's the correction that we had to have. It's possible as well for this one, probably improbable, but possible. And that would give you, let me just quickly measure this out to everybody, that would actually give a percentage of around, about 20% down. So not too bad. I mean, still well up on the year though. So you got to put it in perspective. Is this stock getting absolutely burnt? No, it's really not. And with a strong buy like that after semiconductors were weakening, it really shows you that this is probably the one that when things turn, Nvidia would be the first to pick up because of that strong kind of inherent buyer growth. And we said about healthcare that it was really sold off. And yeah, it's pretty brutally sold. I would expect it to maybe even get sold more. 132 is not only a golden pocket, but it's also a pretty well traded zone throughout this range. So that's a very interesting level for healthcare moving forward. And you saw the stats before. They're pretty compelling towards the bull end if it does end up getting down to that level. So we're trading real time here in Aussie 200, and I expected it to kind of hit a 74.50 after it broke low, but maybe not this soon. So it's almost there, 75.15 at the time of recording, obviously dropping into a very key support zone, and it'll be interesting to see how the Aussie holds up over the week. HSI, which is of course the Hang Seng, that's also dropping here a little bit into the support, nowhere near as compared to the rest of the market. The Chinese market will do its own thing. It's a bit of a defended zone, so we'll like to see buyers probably recommit around that HSI level. But have a look at this, German 40. Ooh, that's bad. That's quite bad. So if that closed on the low, where to next? You'd have to think 17,144. Now, this German market is actually in really corrective territory now. It was the strongest market all year. It's up 6%, down 6% at this point. It's been doing very, very well. Again, the correction, I think we need to have pretty big sell at this point. So it's moving towards, of course, possible further weakness. It depends on the weekly close. But if it closed like that, I'd think there's more in it towards the negative side. What do you think in the comments down below, though? Consumer discretionary, I like to use consumer discretionary versus staples. This gives us the kind of idea of the American consumer, and clearly the market is going defensive at this point. It just broke below, showing us that there's definitely some downside negativity in terms of how the market's viewing the overall growth of the economy right now. NASDAQ, you'll notice, went down again, hit into one of the major key little support zones here. So it's good that it kind of took the low, and the weekly close will matter. So 17,144, I thought we'd reach this level. It's possible we even go further. If we go to a 4,700 zone, I believe we'll kind of go here on the NASDAQ. And again, for a lot of bulls, that would still be good. Do remember that even if we get down to this price, we're still in an overall higher time frame bullish market. So that will be an important factor. So while this market is short-term bears all day at this stage, there will be still a bull market as long as it doesn't really take out some of these December zones. All right, let's move over to the crypto market, which is starting to nose or dive down back onto the bull zone number 1 here for Ethereum. Notice where it's sitting. And then when we go over to Bitcoin, another one that's starting to dive big time. Take a look at that, 60,800. Bitcoin really putting pressure on this major support zone. If it takes it, it's going to be a pretty interesting Friday because there's not much shelf on this left-hand side. So that really means that while it looks like there's a lot of volume there, there's almost no trade. So the ability for the market to flash dive through to here is quite high. And if you know anything about crypto, around a 30% decline is pretty normal. 15 to 30 is the normal correction inside of a bull run, and that would take us right to 30. So with halving coming up, is this actually the negative thing that always happens into halving? We've seen it before. Is it about to do it? So if you enjoyed today's video, please remember to subscribe and smash that alert button. There's so much more coming out in the next couple of weeks, and next week kicks off major earnings season. Clearly, with the results that we're starting to see in this market, there are some concerns, and I expect it to get even more volatile throughout that point. Thanks so much for watching. We'll see you next time, and good luck out there. Make sure to have your risk management well in place, guys.